Most Australians are sitting on one of the biggest wealth building tools available, and they don't even realize it. Your home might actually already contain enough equity to help you buy your next property. But here's the catch. Used correctly, equity can accelerate your wealth dramatically. Used incorrectly, it can quietly trap people in decades of financial stress. Today, I'm going to walk you step by step through how Australians are actually using equity to build property portfolios and the mistakes that stop most people from ever using it properly. So let's start with a simple truth most Australians never get taught. Property investors don't typically save deposits for every property they buy. They leverage equity. And this is one of the biggest mindset shifts between homeowners and wealth builders. Most homeowners see their home as somewhere to live. Investors see their home as a financial tool. Now, that doesn't mean investors take reckless risks. In fact, the complete opposite is true. Smart investors treat equity like oxygen. They use it strategically, carefully, and with long-term planning. Before we talk about how equity works, we need to clear up a massive misconception. Equity is not cash sitting in your bank. It's potential borrowing power created by growth in your property value and reduction in your loan balance. Let me show you what this means. So let's imagine you purchased your home 5 years ago for $600,000. You took a loan of $480,000. Over time, two things typically happen. The first, property values may increase. Second, your loan balance slowly decreases as you make repayments. So let's say your home is worth $800,000 and your loan has reduced to $440,000. So your total equity is the $800,000 minus the $440,000, which equals $360,000 in equity. Now, here's the important part. You usually cannot access 100% of that equity. Most lenders allow you to borrow up to 80% of your property value without needing lender's mortgage insurance. So in this example, 80% of $800,000 equals $640,000. If your current loan is $440,000, that means you have approximately $200,000 of usable equity. And this is where many investment journeys begin. Now, let's talk about how investors actually use equity in real life. There are typically two main ways equity gets used. So method one is called deposit funding. Investors often use equity to fund investment property deposits, stamp duty, and purchasing costs. So let's run a realistic example here. You want to buy an investment property worth $600,000. Typical upfront costs might be roughly 20% deposit, so $120,000. And then you got stamp duty and purchase costs on top of that, which is about $30,000. So total required funds is around $150,000. If you have $200,000 usable equity, you may be able to fund those costs without saving new cash. This allows investors to enter the market earlier and often build portfolios faster. But, and this is critical, equity does not remove risk. It simply changes where the funds come from. This is where I want to slow down because this is where investors either succeed long-term or run into serious trouble. When you use equity, you are increasing your overall debt position. That means your ability to manage cash flow becomes even more important. Let me show you a scenario that I've seen many, many times. So an investor pulls out $150,000 equity from the home. They purchase an investment property, but they only focus on, can I buy this property? Instead of asking, can I comfortably hold this debt structure long term? Then something happens. Interest rate rises. Maintenance cost appears. Rental vacancy occurs. Suddenly, stress levels increase. And stress leads to poor investment decisions. The strongest investors we work with don't just calculate entry costs, they stress test their portfolio against worst case scenarios. Because property investing is not getting into the market, it's about staying in the market. Now let's talk about why equity is so powerful when used strategically. Property wealth is often built through what we call equity recycling. This means using growth from one property to help acquire the next. Let's run a simplified long-term example. All right. Investor buys their first home at $650,000. Over 7 years, that property grows to $900,000. They access $180,000 of usable equity. Then they use that equity to purchase their first investment property. That investment property then grows, generating additional equity. Over time, this process can repeat. And this is how many Australians transition from one property to owning multiple properties across decades. It is rarely about earning dramatically more income. It's about using assets strategically. But there is one major mistake I see homeowners make when accessing equity, and it often delays their portfolio growth by years. And I'll explain that shortly because it might just change how you structure your loans completely. One of the most common mistakes Australians make is mixing personal debt and investment debt incorrectly. When equity is accessed, it should typically be separated into its own loan structure. Why? Because clarity creates flexibility. Flexibility creates long-term options. Let me explain using a simplified concept. If equity is structured poorly, investors may lose tax clarity, might limit refinancing options, and create unnecessary risk exposure. But when it's structured properly, equity becomes a controlled tool rather than uncontrolled leverage. And this is where professional planning becomes extremely valuable, because once loan structures are set incorrectly, they can be difficult and expensive to unwind later. So remember earlier I mentioned biggest mistake homeowners make with equity. Here it is. They wait too long. Not because waiting is safe, but because uncertainty creates paralysis. Many Australians sit on usable equity for years because they don't fully understand how it works, how to structure it safely. And during that time, property markets move, opportunities pass, compounding gets delayed. Now, this doesn't mean everyone should rush out and access equity tomorrow. It means clarity matters because timing the market perfectly is extremely difficult. But time in the market, historically, has been one of the strongest wealth drivers available to Australians. Let me share a simplified example based on a common scenario that we see. A Melbourne couple purchased their first home in their late 20s. They focused purely on paying down debt and saving cash. 8 years later, their property had grown significantly, but they had never reviewed the equity position. When they finally assessed it, they had enough usable equity to purchase 2 investment properties. Had they understood the equity position earlier, their portfolio timeline may have accelerated significantly. And this is why education and clarity can be just as powerful as income growth. If you remember nothing else from today's video, I want you to remember this. Equity is not free money. It is a powerful financial tool that can accelerate portfolio growth, reduce the need for new savings deposits, create leverage across multiple properties, but it must be supported by strong cash flow management. You must have proper loan structuring, long-term investment planning, and emotional readiness for market cycles, whatever is thrown at you. So if this video helps you understand equity, I want you to drop a comment below and tell me, did you realize how much equity you might already have? Or is this something you've never looked into before? And if you want more honest property education without the hype, make sure you subscribe because that's exactly what this channel is built around. Now, if you're watching this and thinking, I own property, honestly don't know how much equity I have or how to even use it safely. That's exactly why we work with clients through structured investment planning at Investor, because equity strategies are incredibly powerful, but they need to be tailored carefully around your income, lifestyle, goals, and risk tolerance. If you want clarity around your equity position and how it might support your investment journey, you can book a strategy session with our team using the link in the description. We'll help you understand your usable borrowing, your usable equity, your long-term investment potential, and whether using equity actually makes sense in your situation. So remember this, most Australians don't build wealth through property because they save massive deposits repeatedly. They build wealth because they understand how to use assets they already own, strategically, patiently over time. Thanks for watching, and I'll see you in the next video.